Today, I have a treat for you. Today, in Trader Tip Tuesday, I'm going to share with you a recording that we did in one of our mastermind groups. And it's a little bit long, so hopefully you'll have time to watch the whole recording. But what you're going to see in this mastermind is the kind of thing that I love to do with students. And one of my students, Danny Botha is an excellent trader. He's an excellent professional trader who's been trading for some time. And I've worked with Danny both in helping his actual trading, but then also in helping Danny implement options. And you're gonna see in this mastermind call that Danny comes into a hot seat and he talks about a trade that he did last week in the British pound future at CME. And in this trade, you're going to see how he thought about it, and then we're going to discuss how he could have managed it differently, because this is one of those trades that he was right, but he didn't make any money. So this is the kind of thing that I love to work with students to help them realize the power of options and how they make the right decisions to have an option actually outperform the underlying. So enjoy this mastermind. And if there's anything we can do for you, let me know. And just like every other week, this is an example of how we are bringing different trading tips to you to help you perform at an elite level. So enjoy. I'll see you next week. So why don't we just start with sharing what are you bringing to the hot seat? What's the situation that you're looking for feedback on?
I've been looking recently to try and integrate options into my futures trading and forex trading, and I've been looking at different strategies. And this week, I looked at a few scenarios where I felt very strongly. The one I want to look at was the British pound.
Yep,
it looked very bullish, and I saw an opportunity. So I wanted to explore options. So I went in with an option strategy. And yeah, I just want to step through it. And it initially was working really well. And then I botched it up badly, made a bad strategic error. And I'll explain what happened. And I guess my trading is kind of shorter term over a couple of days. And I'm really starting to see the potential of these options. I've never really come to value them in the very short time frames. Longer time frames, absolutely, I've always seen the value. But when you're trading over a couple of days, and what I'm really seeing is exactly what Chuck has been saying, that it takes a lot of the psychological pressure off when you can put positions on without a stop. And these positions are incredibly forgiving. You'll see the way I placed this trade. I mean, I entered badly, and still the trade was very forgiving, would have made very good money had I not done what I did. And I'll explain the reason for that.
Yep.
So yeah, I see huge potential. And the nice thing is you can be a lot more strategic with these trades. If you have a view on where you believe price is going or how it's going to play out, you can put orders in the market that can get filled when you're not watching. It takes away, when I'm trading the underlying, I have to really be on top of the market, because I've got to be in front of the screen when the trade sets up. Otherwise, I miss it. With options, you can be a lot more loosey-goosey and still get all the value, and it's phenomenal. So I'm really seeing it. Obviously, the difference, you get all of the value of that, but like we've discussed before, you often are trading off the R multiples that you're going for. So I just want to explore if there aren't creative ways of maybe structuring trades that I can get more oomph out of the kind of multiples that I'm looking for. So that's the kind of backdrop. I just want to step you through what happened with the pound this week, how I was reading it, how I set it up, what happened, how I played it out, and then just kind of discuss how this could be done a lot smarter.
Sounds good. Okay. So let's start off with what time frame were you anchoring to?
So maybe if I share my screen, Chuck,
That'd be great.
Let me step through, and then you can. I've kind of looked at this through the framework of the method.
Yep.
Even though I kind of use other methods as well, and I saw it very clearly with the fib levels and that. But let me. Okay, so I was looking at the pound, and this is. I mean, they're weekly bars, so it's the quarterlies that we're looking at. And I'm not going to go hugely into the technical side because and how I looked at it with through different aspects of Fibonacci. I don't want to confuse what we have here, but if we just look at it through this lens, this kind of had been in a downtrend, and now it was kind of in congestion.
Right.
But to me, this is looking incredibly bullish. And just very simply put, if we just look at how this was setting up, because this was this week's bar right here. So this is how last week had finished. So with this particular trade, what I'm looking at is I'm anticipating what is going to happen this next week. So I'm not looking months ahead. I'm saying the coming week is where I'm looking for the opportunity. So I start on this time frame. And just one thing I'll point out here, if I just draw this in, there was a very, very strong fib level right in here, where you can see before price had come down, he respected this level as support. Then it was very strong resistance, again, broke it, came back and tested. And it also, with the method, was on top of value here. So this was to me very, very compelling. You had a very strong push off this level. So coming into this week, I was thinking, I need to be a bull. I need to be buying here. So I need to look for buy setups. If we look on the daily, it was kind of in congestion, had kind of bounced off a level here, was looking bullish. On the, when I say the daily, I'm talking the daily bars. That would be the monthly background. And here, the weekly background, what had happened, price had just broken out. Okay, so what happened is price came back, tested. I've got the 200 moving average in here. I tend to always put it in. I just find it such a strong player in the market. I like to be aware of where it is. My tactical time frame is this, the daily background or the hourlies. And so what I did is I said, I'm going to be bullish, and I want to buy a bull spread. So what I did, price played off a level, and I was looking for a retracement, and there happened to be, sorry, let me just turn this off.
Sure.
There happened to be a very strong fib level over here, which also had a prior low, and it was also the bottom of value. So this was a bad entry to start, but I had a view. I just want to enter with positive reversion. So what I did is when price came down to this level, it came to around the 25. It had just broken through. It was like the 25.50 level. What I did is I bought the spread, and let me just draw it in. It was the 25.50 over here to the 26.50. So it was 100 pip spread from there to there. And I paid 38 pips for that. So I said, okay, this is a, it's retracing strongly. Somewhere here it's going to find a bottom. So and this was on Monday, so I've still got the whole week to be right. This is super bullish. So I'm going to be a little more cavalier about my entry. I'm buying a big spread. and I'm bullish. So I believe whatever happens. And this showed me right off the bat, I mean, almost for the next day, the position was underwater.
Yep.
And it showed me how forgiving these positions are. I mean, I was very relaxed. Price sat under here, but it did bounce and started working its way up. Then it was in the money, push, 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 push. And it came up to this level where it was getting very close to my short strike.
Yep.
So I looked back on the daily here and I said, okay, this is where we had prior resistance. So this is a level where I can anticipate sellers are going to step in and hold the price here.
Yep.
And we've only got a couple of days to play this out. So, and on this level, what happened is I saw this price started to hesitate, had a bit of a reversal, and it was struggling. So I said, okay, I don't want to give back profit. And it seemed at the time a smart thing to do is let me convert this into a butterfly. So what I did is I sold a credit spread. I sold the 27.50 credit spread and thought that this would be a good move. Let me just draw this in here so you can just see it visually. So over there. So when price was down here, it was at this level, I sold a credit spread for 30 pips.
30
pips. So I thought, well, that's great. I own a 100 pip spread for now 8 pip debit.
Yep.
And I thought this is a good position. Price can bounce around and I have a decent chance of making money with it. But of course, the market, and the other thing I factored in is that it was a big news week. There was lots of stuff coming out. So
exactly.
There could be big reversals. Anyway, it turned out not to be a good strategy. As you can see, price just turned and exploded. So what should have been the way it had set up at a 38 pip debit spread that I put on, I mean, that had a 1.6R potential. And had I just left it, it would have been a great trade. But I got too clever with this and ended up taking a 0.2R loss. I just held it in here all the time thinking, well, there's news coming out at any point. There could be a big reversal. So anyway, I learned a lesson. If the week is very, very bullish, don't bet on congestion. Don't put a butterfly on. Just keep the spread going. So my question is this, Chuck, because it seems to happen a lot. There was a similar setup in the euro, and again, I could have had a really good trade in that. I didn't put that trade on because I thought it's a similar trade. It's correlated with the dollar. It's kind of the similar trade, but it had also a phenomenal setup on the weekly bars. There was also a very good setup in copper, also very strong weekly. I tried to get into that one, got just a little bit too aggressive with the pricing of the spread and just missed it by a few ticks and then it exploded away from me. But my question for you and for the group is, if you put a trade on like this, and this was it was, I put it on Monday because that's when it played out. Yep. The options were expiring Friday. And within a day or two, price rockets up to your short strike.
Yep.
What are smarter ways of trying to get more R out of the trade without, giving up some of the potential downside, but trying to engineer more potential R's if price really keeps going like it did in this case?
Yes.
So that's the one question. The other question is, when you do have a bullish week set up like this, where you just have a strong conviction it's going to be a strong play, and you're waiting for price to bounce off some level, are there smarter ways of setting up than just buying the broad spread? This buying this broad spread seems like a very safe option because you kind of just buying very bullish real estate in the market. And if the bullish idea plays out, you are going to make money, but you're not going to make very high R multiples unless, along the way you can engineer something else into it.
Correct.
So that's kind of what I want to put up for discussion.
Yep. Okay. So, a few questions I have for you. So it was expiring yesterday on the 16th, correct?
Yeah.
And was it a morning or was it AM or PM expiry? Do you know?
It was a morning expiry. It was 9 Central, so 10 o'clock.
Yep. Okay. Perfect. Okay. And then when you put this on, what was your target?
My target, when I looked at it loosely, was the prior high. So it was kind of 20, 28, 28, 70, 80, because I thought that's where it's really going to run into resistance. Let me just go back here.
Yep.
This level here that I've drawn in. I said that's where I feel there is going to be some resistance.
So 126.80.
Yeah.
Okay.
That's
okay.
why I thought I felt comfortable with the 126.50 short strike.
Got it.
To start with.
Yep. Okay, good. Okay, this is all useful. Okay, so let's start working through this. And before I go, does anybody have any questions for Danny other than what I asked?
Danny, when you bought your spread, did you buy your spread when the price was at the money, or did you do it when it was breaking and targeted up to be out of the money?
No, it was close to the money.
Okay.
And that was a mistake. I realized I should have waited. If it had come down and it was a little bit out of the money, I realized afterwards as I assessed it, I could have bought this spread for between 30 and 33 pips. So had I been a little more patient, and that would have then allowed for a 2-to-1 potential.
Okay, so it also spec'd out at a 2-to-1 risk reward.
Well, that would have had I left it, but when I bought it at the money, it was 1.6 R as a potential. It was 38 pips on 100 pips. If you do the math, it's 1.6 R.
Okay, and then when you and then the position went through your short strike pretty quick, right? And you still had about 2 days worth of expiration to go.
Yeah, well, the first about a day later, it went close to it, and then came back. And then the second day,
then that's when you went completely through.
Yeah.
And you still had till Friday morning.
Yeah.
In terms of time value of the spread. Okay.
Yeah, exactly.
Well, congratulations on making a good trade. Okay. I mean, maybe not the butterfly part at the end, but I'm sure Chuck will have some feedback for you. But I know from my experience with these vertical spreads, it's not ideal for them to be completely in the money right away, right? Because then you have the risk of waiting around to see if you're going to be able to capture your full profit or not. And, with 2 days to go and, with the spread only being, 5 days with 2 days to go, I really don't know how much extrinsic value is left in that spread to bleed off, but, you want to wait and let it bleed off. But then there's the inverse R question, right? Where as long as you're sitting there waiting for it to burn off, you have to decide whether or not it's worth it for you. I mean, I personally don't really understand how to trade a butterfly at the end of this. Chuck and I talk about these a lot, and he always tells me to box them out, like convert them. So if you're long this spread, you would sell the corresponding option spread. Like if you're long a call spread, you would sell the put spread, and you would turn this into a conversion right away to capture the profit on it. If it was at a point where you didn't think you could get out of it from a liquidity standpoint, but otherwise, you could have waited. You could have been patient and waited to see what was going to happen, and then had a plan for what you would do if it was to stay there or rally up, or have another plan if it was to go down. And then, you know, I also was wondering what your plan was. If you were wanting to keep this position over the weekend and roll it to a new position, did you have any thoughts of doing that kind of thing?
No. I mean, my intention is really to close these at the end of the week. I want to maximize. It's just not part of this strategy because I'm looking for a setup that I have a strong conviction the next week is going to be very bullish or very bearish.
Yeah.
And I just want to capture that bullish move or that bearish move. For me, I kind of look at it. You just want to be in on the easy money. You just want to get that big push of that momentum.
Yeah, but you know, looking at the chart too, it's like it almost looks like you picked the perfect spread, right? Because the market almost started, you know, showing you price rejection and support right at your short strike. So, you know, this to me looked very bullish when you had it on, and you know, I think that as soon as you saw, like, you know, you saw it rally well out of the, you know, get well into the money for you, and then it broke down and came right down to your short strike and just stayed there. You know, and it didn't really penetrate through there very much. You know, it seems like you found the perfect support level there, and you know, I guess maybe it would have been pretty good just to hang on to it and see what would have happened, right? At least a full day.
Yeah, the very first day when it came up on the Tuesday and came very close to the strike.
Yeah.
It was trading at probably about 40% of the maximum potential profit. So I thought, well, you know, I have a choice. I can take the trade off and I can make 40% of the 1.6R or just let it run. And yeah, and then anyway, but I just thought I didn't want to take it off when there was still so much potential profit on the table. But it is a problem when it shoots up to that short stop.
Yeah, because you still have all the time decay and any volatility that's been priced into the spread, you know, is going to have to burn off over time in order for you to get the capture the full amount. But I don't know. I mean, it's really, when that happens, it's really hard to decide sometimes what to do, because you know, the longer you hang around, they can turn around and reverse on you pretty quick, and then you get nothing, right?
Mm-hmm.
So that's always the challenge that I find with this too, when this happens right away like it did.
Yeah.
Yeah. Other questions? Okay. How about other? Now let's move into suggestions. Does anybody have any suggestions for Danny? If they want to talk through with them. Okay, Danny, looks like it's you and me. Okay, so there's a few things that I want to ask. So when you put this on, did you just put the spread on, or did you put on the future or cash first and then rotate into the spread?
No, I just put the spread on.
Okay.
I just priced it at the spread and just bought the spread.
Okay, so now at the time you put the spread on, if you had not done the spread, would you have been willing to, is this a trade, if I took the spread off the table, is this a trade that you'd have been willing to initiate in the future or cash on your own, on its own?
Yes, I just wouldn't have done it right here.
Okay.
I would have done it, I would have waited. And just, you know, because it was options, I was a lot more kind of loose on the entry, because I knew it would be forgiving. But if I was entering the underlying, I would have waited. I would have definitely waited for price to reverse at a key level.
Okay, great. And when you put this on, did you express the entire trade in the call spread? You did, right?
Yes. Yeah.
Okay. So let's start there. One of the things I think is really useful with these is if you watch when I do these, and some of it depends on time of day and things like this. But I'm going to do, in general, I'm going to do the option spread at the time I would enter in the underlying. Okay. I would be using the same method to get in. So you would have been waiting, you said, on the underlying.
Yeah, yeah, and I
Waiting.
should have. It was a mistake. I realized that when price carried on moving against me when I entered, I realized I was too hasty getting in.
Yeah.
So I totally get what you're saying. Yeah.
Okay. So great. All right. So there's a couple aspects of that we can talk about that can be useful. So a lot of times what ends up happening, Danny, is I do the underlying first just to make sure I get my price. Because remember how you said it was in the copper, you said it, did you just miss the spread? Okay. Like that won't happen to me very rarely because I'm going to do a lot of times I'm going to do the underlying first, make sure I get my underlying in because this is a directional trade for you, right? At the heart of it, it's a directional trade. We're just trying to express it in a better way, right?
Yeah.
So I'm gonna get my underlying in to know I get my price, and then I'm gonna line up my option spread, and I'm gonna enter my option spread and sell out my underlying. Okay. Now you could just do the option spread at the time you do the underlying. I do that sometimes too, but I'm going to make sure I don't miss it. I'm not going to miss it by a tick. No effing way am I going to let that happen.
Yeah, and that happened to me. But now, Chuck, when you say you enter the underlying and then put the spread on, do you enter the underlying and immediately put the spread on?
Well, that's the thing. Once I get the underlying on, Danny, I don't have to put the spread on immediately. Now, typically, I'm going to try and get it on pretty quickly. There's not really an incentive for me to wait, but sometimes, let's say I go in and I get a crappy market. This is another issue you all might face. You might have a spread you want to do. You come in and look at the market, and the market's not very good. Okay, so and you're like, well, I don't want to pay up for this. And then, of course, you try and squeeze it so you don't pay up, and then you miss the whole damn thing because it takes off, right? If I get the underlying done first, then I got that. That's my ace in the hole. I know I'm covered. Now I can take my time with the spread and make sure that I get the price I'm comfortable with the spread. That may come a minute after I do it, Danny. It may come an hour after I do it. I don't know.
Why I'm asking this, Chuck, is that the moment you enter the underlying, you obviously are exposed if price moves against you.
Correct.
So if it starts moving against you, are you going to make sure you put the option trade on quickly, or would you enter the underlying and have a stop still that you're going to get out if it's moving against you?
Yeah. So in general, Danny, I would do more like the latter. I'd probably still put my stop in like I would. And I occasionally will have a trade that I'd enter an underlying, I'm working the option spread. And by the time I'm kind of ready to do the option spread, I'm stopped out of my underlying. Then I just walk away. Now, part of the reason you're doing it was why?
Doing what?
But so part of the reason you chose to do the spread was why? You kind of said.
Well, so that I didn't have to have a stop.
Exactly, right? So at that point, you could still do the option spread and take the stop off because you weren't going to have a stop anyways.
Right.
Now, what you'll have is you'll have a loss on the underlying because you bought it and you're getting out lower, right? But you're going to be buying the spread. What?
You'll be buying it cheaper.
You're buying it cheaper to compensate for it, right?
Right. Yeah.
Okay. So that doesn't really matter so much. So this comes down to your objectives. If your objectives are to get a position on with no stop, well, you can work the underlying, you can get in the underlying still, and then you work the spread, and you're going to get the spread cheaper, which is going to eliminate some of the risk, and you just swap it. And you could work a stop in the interim just to protect yourself, but you'll swap it in to the spread, and then you're good to go. Another thing is when it was first coming in, I'm just sharing different thoughts. You could put a smaller position on in the spread and wait on the rest, right? Kind of split it. I'll buy some spread early because I just want to have this on, having the exposure, knowing I got my risk contained. And then I'll work the rest lower. Like either one of those is fine. But in general, I work a lot of times, I do the underlying first, then I rotate to the spread to make sure I get all that tight. And like you said, you don't want to alter your trading all that much to do this. So if you would have normally waited to buy the underlying, then you probably should be waiting to buy the spread. Right?
Yeah.
Yep. And like I said, if you feel strongly about it, well, you could put a little small position on while you're waiting, and then you're hedged. You're smoothed it. But in general, that's what I would do. Okay. Now, once you get into the position and the position is working, a key element in here in the discussion is we're talking about target and we're talking about path. Okay. So the target, you had a target at 126.80. One of the things you said to me is you set the strikes you picked were actually accounting for your target, right?
Mm-hmm.
That was very good. That was a very good step that you took. Now, ideally for you, how did you see the market going to that price? You said it went there faster than you thought it would. What would you have thought it would do?
I didn't have a view on that, Chuck, because it was a kind of a week with lots of news.
Yep.
So I thought price might chop around quite a bit. So I didn't have a strong feeling of whether it would get there quickly or slowly. But I just knew my time frame is a few days. So in those few days, it's going to get there.
Just out of curiosity, do you know what you paid for the 125 and a half call on the spread?
Yes. The 125.50, I paid 51 pips, and I sold the 26.50 at 13 pips.
Okay. All right. So one thing I want you to look at, and we just this comes the reason. Here's where I'm going with this is with the expectations. Okay. We want to be really clear about what's the path we think we're going to get. So we know the target's 126.5. That's good. Okay. Now we're asking the questions about the path. And what you're telling me is that, well, I'm uncertain about the path. It may go there quick. It may go there slow.
Mm-hmm.
Right. So one of the things that I would encourage you to think about is in this case, we actually could have bought the 125.5 call outright. And it would have been more expensive, but what would it have given you? What would it have given you buying the 125.5 call instead of spread?
Well, it would give you a higher delta.
You had a higher delta. Yep. So one of your objectives was to eliminate the stop, right?
Yeah.
So would that have done that for you? Would you have needed to stop if you bought the call?
No, I wouldn't have. But I would have dropped the potential R multiple. That could have been, one consequence, because now you're looking at a 1-for-1 basically.
Okay, so let's look at that. So you're paying 51, right? What was the 125.5 call worth at expiration?
Sorry, the 125?
Yeah, what was the 125.5 call worth at expiration?
Expired
Friday morning.
At 128, so it was 150.
It's 250.
250.
And what did you pay?
51.
So what's the R?
It's 5.
5. Versus in your spread, it was what?
1.6.
1.6. Now, I'm pointing this out to you because this comes back to the objectives. If you felt when we buy this spread, ideally we want the market to go to the strike slow. You'll hear me say this. We want to go to 126.5 and die. You had a target at 126.80. So your target was in the right place for the spread you're choosing, because to get there, the whole spread would have had to go in the money, right?
Mm-hmm.
Okay, so that makes really good sense. That's why I said you did a good job picking the strikes. The next aspect to this is the path. How are we going to get there? For this spread to be really good, we want to go there slowly. We want to go there slowly. What did you tell me about the week?
It was lots of news, so potentially a lot of volatility.
Right, exactly. So if there's lots of news and potentially lots of volatility, what's the likelihood we're going to go somewhere slow?
Not good.
Not good.
Not good. No.
That's what I want you to see. Because one of the things I want to, if we look at this now, if you had done nothing at 126.50, the point that you went to the fly, which we'll cover, if you had done nothing and the market had kept going, it would have worked out well for you, right? The whole spread would have gone into money. You'd made 1.6 R, right?
Yeah.
But if you'd bought the call and just let it go, what would you have made?
Well, 5 to 6 R. It actually ended up at 28. 47, 28.50. So yeah, close to 6R.
Yeah, right. So, but I want you to see, this is for everybody. Do you see the difference here? This is one of the things I want people to understand, because they'll say, well, I made the full value of the call spread. Like you'll see when you guys went through the classes, one of the things that people came back a lot and pushed back on, they couldn't understand. I even had Kevin push back on me on this, by the way. The idea that if I buy a call spread, everybody will say, well, shouldn't the most extreme bullish scenario be the best scenario for the call spread? That's what they say, right? So wouldn't it be best for me that the stock exploded, or that the pound exploded? Wouldn't that be the best scenario? I'm long the spread. And I said, no, it's not. And like, well, but the spread went fully in the money. So this is a relational analysis. We have to compare what we did with what we could have done. And what I want you to see is buying the call versus the call spread. In this scenario, the call absolutely kicked ass compared to the call spread. Wouldn't everybody agree?
Yes.
Okay. That's because of this path. Now, if the market had gone slow to 126.80, well, the call spread would have been worth, you had made 62 cents on it, right? And at 126, let's say 126.80, the call is worth 130. You paid 51 for it, so it's worth 80. Your spread's worth $1. Or no, well, it's worth 130, and your spread's worth $1. They're about the same. You guys see that? The call is still slightly better, by the way, but they're roughly the same. So if we were going to get this slow grind to the strike, let's say we go to 126.40. You go to 126.40, your spread's worth 90, and you paid 38. You'd be making 52 cents on it. The call would only be worth, it'd be worth what, 80? It'd be worth 90 minus 50. It'd be worth 40, right? So at that point, the spread outperforms the call. So one thing, let me just share my screen here, because this gets into the schematic I showed you guys in the last class. Okay, we showed you this. We went over this schematic in the last mastermind, where we looked at being long, and we looked at using 4 different strategies to express our long. So if we look, one of the things that we talked about is that this 1 standard deviation. If we think the move is going to be greater than 1 standard deviation, we want to buy the call. If we think the move is going to be 1 standard deviation or less, we want to buy the call spread. Okay. Now, this is where you thought it was going to go. And that's good. But then there's the path issue, which you weren't sure how long it would take to get there. In this spread, we want the market to go there and die. And what we said is that's not likely when we have FOMC and ECB and BOJ and all going on, right? So I just want to point that out. If you look, one of the questions you got to ask yourself, all of you, when you go to do a vertical spread, is the 13 cents that you're picking up on the short worth what you're giving up? In some cases, the answer is yes, it is worth it. If I think we're going to go there slow and die, it is worth it. But if I think the market's going to be volatile, I'd rather just be long, because it's going to give me the ultimate flexibility to respond however I want. You see this?
Like another consideration to throw in is, when I'm looking at this over a time frame of a week.
Yep.
So this was a bullish setup. So I'm looking for the low to be put in early in the week.
Yep.
So it comes to a point where if I believe this is a good chance that low is in,
yep,
I don't have to buy the call at the money. You can also buy the call slightly out of the money, and save that 13 cents that way, get a slightly better price, and that can ramp up the R multiples as well.
Absolutely. And I'm glad you brought that up, because the other thing is, because you thought the target was at 120, you were targeting 126.80. That's a lot different than if you were targeting 128. Because the reality is what was happening is you were buying low and you were targeting a recent high as your target. right? But if that was not there, then I would be telling you that buying out of the money spreads or buying out of the money calls would be the better route to go, because they'd have the reward to risk on those would be much better. And if you got the move like we did, if we got that kind of move and you expected the kind of move we got, you kill them on it. Then you're not looking at 5R, you're looking at 10, 15, 20R when you get this right. Okay. So, but I'm coming back to, we have a target at 126.80. So we have that's our target. We don't want to, we want to, that's what we said. That's what we're going to go with. So we're now looking at the strategy around the belief that that was a target. Is everybody tracking with what I'm saying here?
Yeah.
Okay, good. All right. So now so we put the spread on and off it goes. All right. Now, when we come up into resistance, what you did, Danny, first of all, the way that you were thinking, I want to give you props. You were really trying to think about this the right way. You were thinking, I'm sure what you were thinking is, by selling this call spread, I'm going to get a credit in that's going to reduce my basis, and it's going to give me a chance to still get a bunch of upside. Is that fair?
Mm-hmm. Yeah.
Okay. So the thought process you had, I wanted you to know, was really solid. But as you said, it's more the execution of it. So let's think about it. We targeted a spread that we went to our target, and we said, well, we go to the target. We don't know if we're going to go there in a day or we're going to go there in 5 days or 4 days, because there's 4 days left. We don't know the path. So that was an issue, right?
Mm-hmm.
So when we sold the vertical spread and we went into the butterfly, what did we need the position to do there ideally?
Just hang around the same, around that middle area.
Correct.
Around the short strikes.
Okay, great. And that happened on Wednesday, right? Did it happen on Tuesday or Wednesday?
Yes. Wednesday it broke through.
Okay. So it basically went there in like a day, right? Roughly a day and a half?
Yeah.
Okay. So the timing matters a little bit, because what do we have Wednesday afternoon? Maybe have you show your chart. Why don't we just look at your chart so we don't speculate? Can you share your chart again?
Yeah.
As he's doing this, do all of you see the importance of the path? This is why I talk about the path so much. The path is where all the profit is in this. It's where the extra profit is. Okay. So you got to your price. It was Tuesday afternoon.
Yes. Around.
Okay, good.
1 o'clock.
Okay. Yep. Okay, great. So let's talk about this for a minute. So this is Tuesday afternoon. We still have to weather FOMC on Wednesday, ECB and BOJ on Thursday. We got a lot of news still sitting out. So we've put ourselves in a butterfly, and you said we want the butterfly to sit, right? So what's the probability we're going to sit for the next 3 days?
Not good, but I was hoping price, went up, came down, went up. It's just I thought it was a pretty wide butterfly, but clearly not wide enough.
Yep. And again, all right, I'm just being helpful here, right?
Yeah, sure.
Yeah, but I'm just trying to bring you through to see what we were doing versus what our expectations are.
Mm-hmm.
At every point along the way, we want the position to match our expectations. All right. So one thing you could have done that would have gotten you some of the result you wanted and still preserved what the upside you had is you could have come and bought like the 126.5, 126 put spread, or even the 126, 125.5 put spread. So let's talk about that for a second. Let's say we bought the 126, 125.5 put spread. Okay, I'm going to take screen back. Okay, so we're long a 125.5 call. and we're short a 126.5 call. This is our core position. Okay. And then we rally to 126.5. We could have come in and bought, let's say, a 126, 125.5 put spread. What this would have left me with is, what is this position, everybody?
That's like synthetic underlying, isn't it?
Yep. Long or short?
I'd say that you're a long call, short put. That would be like long underlying.
Long
Yep.
underlying.
Yeah.
Okay, we're long underlying. And then we can basically say, okay, we're long underlying. And let's just assign it to this call. We could do either one, but we're going to just assign it to this call. So if I'm long underlying, short a call, what position is this?
That's a diagonal. Well, that's like a vertical spread, but it could be I call it a diagonal spread.
Just focus on the 126.5 call and the 125.5 synthetic. What is that position?
So you're long stock and short call.
Yep. What position is that, everybody?
That's a covered call, so it would look like a short put.
Okay. So we're short a 126.5 synthetic put. You see that? We're short a 126.5 synthetic put. And what do we long here?
That's long 126 put.
Yep. So we're long.
So now you're in a put spread.
Yep. We're short a put spread.
Yeah.
Right. We're short a put spread. And what do we want the market to do?
Well, in this situation, if the market was to roll over, that put spread would look pretty good. And that would probably be very good for your position as a hedge. If I'm reading that correctly.
We're short a put spread. Where do we want the market to go? Want to rally, right?
We wanted to rally.
We want it to rally. So we'll make money if the market goes up. We'll make money if we sit. We'll lose money if we go down. Right? But we're going to lose less money going down than we would have before. If I'm long the 125, 126.5 call spread and we go down, that spread's we're going to lose the value of the spread, right? But by buying this put spread, what we're doing is we're minimizing the amount of money we can get back. So Danny, when you sold the 126.5, 127.5 call spread, you sold that for 30 cents. You were long the butterfly for 8 cents at that point. You paid 38 for the call spread. You sold a call spread at 30. So you were long a butterfly at 8 cents.
Yeah.
So at that point, this was $1 butterfly. So if you stuck at 126.5, you could have made $1 on 8 cents of risk.
Yeah.
I mean, that would have been phenomenal, right?
Yeah.
But the likelihood was low. That's what we've established. But by buying the put spread, what you're doing is you are basically capturing the gain. You're capturing a chunk of the gain that you made on the spread going up that you will not give back when you go back down. Because now you've taken $1 spread and only made it 50 cents. So when you have $1, how much can you lose?
Well, the whole spread.
The whole spread. Yep.
Yeah.
And in this case, it's a bigger number. If I'm long a 50-cent spread, I lose the whole amount, but it's going to be a smaller amount because it's only on a 50-cent spread, right? Not $1 spread. So we'd have to look at the exact numbers, but at this point, you probably have locked in a profit on your spread, and you can kind of let the rest of the short put spread go. And what did the put spread go out worth at expiration?
Zero.
Right. So you got to keep the credit that was left. You get to keep that. That's one thing you could have done that was simple, that met and I want you to see, everybody, this met your objectives, right? Because you hedged such that if the market rolled over, you wouldn't give the money back. You wouldn't give all the money back, right? And if the market continued to rally, you could keep making money. So I want to show that. Now, something else I want to talk about, and this is something you guys will hear me discuss a lot, that doesn't, it's probably the hardest thing I say. Dominic will attest to this. I see very, very few people who are willing to do what I'm going to tell you. We go to our scenario planning. So when we go into Wednesday, Danny, in our scenario planning, we're listing our position, and our position is we have on the 125.5, 127.5 butterfly. We're longest butterfly, right? We go through and we do our scenario planning, and we're looking at what's going to happen if the market goes up, what's going to happen if the market goes down. And I know you do this already, Danny. You're going to have your support and resistance levels, right?
Mm-hmm.
So one of the things you could have done, I'm going to show a couple different ways. We do our scenario planning. We got FOMC going the next day. So we're doing our scenario planning around the day itself and around FOMC. And each of you will do this to varying degrees. You might have a detailed analysis of FOMC, or you just might have more of a general plan. Okay, but we know we have this butterfly on, and we know that the butterfly is going to lose money where, Danny? At least give back profits.
If it goes towards the long legs.
Right. Either
the
way,
long
right?
strikes, yeah.
Okay. So if we go towards 127.5, or we go towards 125.5. So in our scenario planning, we could be going through here and basically saying, and we even go back and look at the bands, but we can determine levels that if the level's breached, the market's likely going what?
Higher or lower.
Right. Okay. So if I have the butterfly on and I breach the level, what I can do is step out and dump the leg being breached.
Mm-hmm.
This would mean that you'd have to buy back the 126.5, 127.5 spread at a loss. This is the thing I see I rarely see traders willing to do this. Why do they not want to buy the spread back?
Well, they don't want to realize the loss. But in this case, you would still have your embedded profit from the long spread. So, you're still in the money on the whole position.
Right. So there's the right thing to do, and there's your psychology, and they're not always the same.
Yep.
Everybody see this? The greatest traders I know will take a hedge and dump it for a loss in a heartbeat. They're not married that the hedge has to be a winner. When our environments shift, what happens to our expectations?
They change.
Yeah, they shift, right? We always talk about we want to take action when the environment shifts. So in our scenario planning, we would be looking at this and saying, okay, if we breach this level, I'm going to get out. I'm going to dump the leg that is not working. In this case, we rally. I'm going to dump the call spread. I'm going to buy it back at a loss. Okay. That's one solution. Another solution, if you're like, I don't want to do that, but I want to try and capture it. The other thing to remember is that you're in a butterfly, and the entire time, this butterfly has value. What price are you long the butterfly from, Danny?
The overall cost, 8 pips.
8 pips. Now, at the time you went into the hedge, you had, I think you said 40 pips in profit, roughly. Out of the 62 you could realize. Does that sound right?
Something like that, yeah.
Or maybe it was a little less. You said
40% of the total potential, yeah.
Okay, so 25 ticks, right? You have 25 pips of profit at that point. Okay, so at the point you go into the spread, you're long the spread at 8, but it's actually worth 33. That's why you have 25 pips of profit.
Mm-hmm.
Did everybody see this? Okay, so the spread is worth 33 that you're long at 8. If I breach, let's just say I come out and I say, okay, you said 126.80 was your target. And let's say you put a fade on this, and then you're doing scenario planning. You say, well, you know what? If we get above 127, then this level that I thought was going to hold is not, in my view, is not holding. Keeping this real simple. So above 127, I could buy back the spread. Now I'm just long the original call spread, Or the other thing I could do is I could say, you know what? Just get me out. And you could sell the butterfly at 127, and you're going to sell this butterfly. It was worth 33. You're going to probably sell this butterfly for like 25. You'll realize like a 17 pip profit and you're out.
Mhm.
Instead is we just let it keep going and going, and you watched it go from 33 to what?
Well, I went to -8.
Yeah, it was zero.
I
Yeah, it
lost
went to
8.
zero, right?
Zero value. Yeah.
Yeah, with an 8 pip loss, right? My point is, all through that path, there were chances to sell it and get back more than 8. Does everybody see this? So, but the really key element of this is the scenario planning. Remember, one of the things I talk about is that when the great thing about options, it's very different than underlying. The great thing with options is you can think of it like a slideshow. Okay, so you have a target of where you want to go, but as we move to this target, we're moving in slides, like in increments. And with each slide, we have a chance to reevaluate what we want to do. And at each slide, when we reevaluate what we want to do, we can scenario plan or adjust and make sure that it's now fitting the objective we have right now. So again, this is just useful feedback, right? One of the things that was happening, Danny, is that you had a really good expectation. It unfolded slightly different than you expected, and then it moved away from you.
Mhm.
And as it was moving away, each day you had a chance to adjust for what your view was. You didn't have to let it go all the way to zero. You could have adjusted any day by either adjusting the position or dumping the trade for a win and just being out.
Right.
And you didn't have to wait. Does everybody see what I'm saying?
Mm-hmm.
Okay. For each of you, this is important. Okay. Like this is a very important thing to think about. Craig, you should be writing double notes here. Okay. Because for you, Craig, this is going to be really important. Kind of trades that you're in. We get the path. The path is really big. The scenario planning is really big. And we have the ability to adjust the position as it's unfolding. Now, Danny, one thing I got to tell you is I think it's awesome that you did this. You preface this by starting to say you could see the power of what was here.
Mm-hmm.
I think it's awesome that you did this because you are learning an invaluable lesson from this that you would not have learned had you not stepped out and done the trade.
Yeah.
This is something I'm congratulating Danny, and this is something that's directed also at each and every one of you. Because each and every one of you in your own way are either doing what Danny did and learning or not doing what Danny did and losing the opportunity to learn. Okay. But Danny, you're picking this up and this is going to serve you really well because the next time around or the one time after that, you're going to catch one of these for like 10, 20 R and you're going to come back in here and we're going to break it down again.
Mm-hmm.
And we're just going to high five, give you virtual high fives and move on to the next guy. Everybody see what I'm saying?
Can you diagram the butterfly again? Like you're in a spread, you're in a vertical spread. It goes through your short strike and you're making a decision from a scenario plan to turn it into a butterfly.
Yep.
I just need to visualize that a little better if that's okay.
Yeah. So the butterfly, what Danny did is he put himself in a strategy that looks like this. Okay, another way in this, so the max loss he had was 8 pips in either direction.
Yep.
Okay, and at the point that he got in it, this thing at its peak could have been worth 92. Okay, at expiration, it could have been worth 92, where he was shorted, or he got shorted in here at 33. Okay, so when we're short a butterfly, easiest thing to think about shorting a butterfly is what position does this look like right here?
Straddle, short straddle.
Looks
Yeah,
like
short straddle, right? So Dan, and effectively, you're short a straddle without the risk of the straddle. So he needed the market to sit at 126.5. and he'd make maximum profit at 126.5. But if he starts to get off of that, either way, he starts giving the money back, right?
So when we took the class, you said to put these on near the end of your position, maybe, right?
Mm-hmm.
Like if the market was, you know, up near his short strike and we're getting close to expiration, you could turn it into this, right?
Mm-hmm.
And put some, maybe even put some money in your pocket and then put this on.
Yep. But if I'm going to do this, I have to believe the market is what?
Going to go quiet and kind of stay there.
Yeah, I have to believe it's going to sit. And when Danny expressed it, what was Danny's view?
Well, he had a high volatility view, and
he thought, yeah, right, lots of news, and the market's probably not going to sit still. So fundamentally, you can very quickly see Danny's instincts were right, but he was actually choosing the wrong structure for his outlook, right? Good. Danny, I want to thank you for bringing this forward.
Thanks, Chuck. Thanks for all the input. It's been very valuable.
Yeah, this is kind of stuff that's fun to do. Okay. We have another hot seat, which is the other Danny. So Danny Schulte, let's go over your hot seat. What is the scenario that you're looking for help with?
Can I have one follow-up question to the other one?
Sure.
When you say you rotate the position like from the underlying to the spread, do you usually like really sell the underlying and buy the spread, or do you buy the put for the synthetic long call and then sell the call to get into the spread?
That's a good question. I mean, I think you're going to do whatever's most efficient, but usually, Danny, when I'm doing it, because I'm initiating with the spread, we're talking about in the beginning, right?
Yeah, in the beginning, yes.
Yeah, in the beginning. Okay, in the beginning, usually I will just sell out the underlying and put on my spread, because the strikes I'm picking in my spread are usually liquid anyways, or I wouldn't be choosing them.
Mm-hmm. Okay.
Like, I'm not picking a deep in the money call spread. I'm going to be picking usually an at the money or out of the money spread. So the structure I want to do is usually pretty clean to do just an option. So I typically do the option structure and get out of the underlying. But you can look at both and you just do the one that's most efficient. Most of the time, it's going to be the way I just said, though. Does that make sense?
Yeah, that makes sense.
Yeah.
What's the lowest time frame that you find that it's feasible to use options in something that's reasonably liquid?
I think it really depends on the product. So one of the things that's happening is the volume in the daily expiration in SPX has exploded. Because now what's happening in SPX, a lot of the volume that used to be in E-minis and E-micros are now like in SPX options and E-mini options, but specifically SPX options. Why do you think, Jonathan?
Wow.
Jonathan, go back to your trade you shared with me.
Why it would be in S&P, why instead of minis and micros?
Yeah, it's in the SPX. No, it's not. I'm saying SPX, SPY.
Oh, in the SPY.
What problem would that solve for you, Jonathan?
To be in SPY instead of the future?
SPY options, the daily expiration, as opposed to the underlying.
Well, I guess it would keep you from getting stopped out, getting wicked out.
It's part of it, but there's another big part of this. That's one of the reasons people are using it, but there's another reason it's even bigger.
Is it a liquidity reason?
Nope. Liquidity is good, but that's not it.
Amount you have to put up smaller in the SPY option relative to the say the ES.
Yes.
Say that again. I'm sorry, I couldn't hear.
The amount I have to put up in the SPY options a lot smaller relative to say the ES. Yeah, one of the E-minis.
Yeah. So think of it this way. If I do an E-mini, I got $11,500 roughly in margin to put an E-mini on. If I do E-mini micro, it's $1,150. Okay. I can come in and buy a 1-day SPY call for like $1. How much is that? $100. I can buy an expiring SPY call for 1/10 of a micro. You understand what I'm saying? So what the daily SPY option does is it opens up the door for somebody with a $5,000 account to trade S&P. Because I can buy 5 options for $500 or 1 option for $100, and I'm not going to blow my account out, and I can be in the game. I can't do that with with a micro. So you have all these people that are coming in to trade the daily expiration because, as you said, Jonathan, I don't need to stop, and I only need a fraction. I only need a little bit of money. And that's happening. That happens also in Qs. And then they just trade them. They just trade the option. They don't even trade the underlying. Okay. So it really depends on the product. So SPY, that works great. There's other things you can go into, like even gold, which has a lot of daily expirations. You go in and, the day of, it's kind of shitty. It's not great. 2 days out's pretty good. 1 day out, not so much. Right. So I think in really liquid products, if you have a daily view, you can trade options on a daily view. Look at yes, Marcus, there's daily SPY options every day. Danny, look at your trade. You got to your strike in a day, or roughly a day, right? You got the move in 1 day. So like if you're in the daily time frame, or even if you're an intraday trader like Rodney is, or Chris does occasionally a little bit, or Danny, you do some of this, like you can use options then too, like the day of, and you don't even need to stop. You can just put it on. Now, the trade-off is you got to still overcome the premium, right? So that opens the door to trades that you're right, but you don't make any money. You're right, you lose money because you don't move far enough. But if you just step back and you look at this, and this is where, somebody like you, Rodney, who trades the same thing all the time, it starts to actually be worth it to always have one eye over there, because certain trades you're going to make, you might be able to just go over to Qs and do it and do have way better reward to risk than the trade you're actually hunting in the micros or the minis. Not always, but it's worth it.
You could do something on a really fast time frame as long as it's just super liquid.
Yes, and here's one thing I want to say. This is another thing I'm always pounding the table on, that I don't, there's things I say that people hear me, but they don't do it. One of the things you hear me, I talk a lot about doing what with options. What do we do in your scenario, Danny? What was the better recommendation?
Hedging.
Yeah, but when we initiated, what was the better option initiating for your
just to go long the option.
Just to go long the option.
Yeah.
Okay. So what I want you to see is if we actually just buy the option today, one of the things you said, Jonathan, is the liquidity about getting out. If I'm long the option, if I'm undercapitalized, this is kind of another story, okay? But you guys in general are not this way. If I'm long the option, I don't need liquidity to get out. I don't need liquidity to get out. Why?
Because you can always use the underlying to get out.
Exactly. I can always create synthetics in the underlying, right? If I buy the call, I can sell the future, and I'm in what? Long synthetic put, right? Or if I ratio them, I can put myself in the straddle. I don't need to get out because I have the future. So one of the reasons a lot of people push back on the idea of buying options because they're like, they're expensive and I bleed every day. But the thing that I don't think people realize is how valuable an option is in the scenario that is difficult, which is getting out of your position the day of expiration, which is trading at night. If I have options on and if I'm long gamma at night and I get a big ass move at night, I can always respond when I'm long options. When I'm long a spread, it's more difficult because in like the case of Danny's spread, if we keep rallying, what eventually happens to Danny's delta? He was long to begin with, right?
Yeah.
But if we keep
flat lines,
it flatlines, it goes to zero, right? So if we rally and I hedge by selling underlying, I open the door to what? Being
short.
Being short as the market's rallying, right? So I could have a scenario that I hedge a long call spread by selling underlying at night, and I end up being a really bad decision because the market just keeps going. But if I'm long the call and I sell futures at night, I can't get hurt. I cannot get hurt. I could certainly give some profits back, but I'm in as long synthetic put. Like I'm good. So there's some power in there that allows you to. I always come back to what we want to trade from a position of strength.
Chuck, can I ask a quick question about the situation where Danny could have put this trade on where he would have initiated with the underlying, okay? And then he gets some decent feedback, it starts moving in his favor, and he decides to buy a put at his stop to turn it into a synthetic call.
Yep.
But your position sizing planning enabled you to be long that underlying with the stop, and then as soon as you buy the put, you're actually cutting your delta, so you're actually taking risk out of the position. Would you, in situations like this, possibly go with a straddle, or find a way to keep your delta the way you position sized it from the beginning, or is that just going to be a scenario based decision based on what you read at the time you make the decision?
Tom, I think you're asking a really good question. So what Tom is raising is, could I actually hedge myself by doing a delta neutral strategy, like buying a straddle, such that it's great because straddle makes money, right?
Because this happened to me last year where I had one of my best trades and I effectively cut the risk in half by buying an at the money put.
Yep.
And I really, I looked at it and go, wow, that's cool. I love being in this synthetic structure. It felt awesome from a risk standpoint and stop management, but it wasn't so cool that I took my best trade of the year and slashed my delta by 50%. So
you only slashed it. Yes, and I hear what you're saying. Okay. To be clear, you only slashed it 50% temporarily, right?
Well, yeah, because you're right. Because as the position started working, my delta was increasing. Absolutely,
it would eventually go back to 100, right?
Yes.
But what you're doing is the way to think about it is whatever you pay for that put to hedge it, it's like cutting your R by that amount.
Yeah.
Right. So if you pay 1.5 R for the put, you have a 10 R, you have an 8.5 R.
Yeah. So when I go into something like that, I'm always looking where I put my stop, and I'm considering that's the place that I'm going to buy an option if things are working.
Yep.
And if my outlook is still bullish, and I haven't done this yet, but if my outlook is still bullish, I think I'm going to try to keep the level of risk on I had at the beginning.
Yep. So it comes back to expectations. So buying the straddle would do that for you. You're absolutely right about that. And these are things that we're going to get into in options 301, is stuff that we worked on with you last year, Tom, where we can be buying butterflies out of the money. It could be doing calendars out of the money. The great thing about a calendar is a calendar can actually make money for you while you're sitting here.
Yeah.
It'll make money for you when you go the wrong direction, and you'll lose money on it, but you have a defined risk if it goes in the way that you want, and you'll still have maximum exposure. Right. So if I'm long and I can go buy an out of the money put calendar down near my stop. And if we break, the put calendar is going to make money. It's going to offset the loss of my long. If we sit, my put calendar is going to make money. And if we rally, my put calendar will lose money, but it is a zero bound, and I'm long the full exposure.
It's awesome.
Okay. So nobody does this, but these are things we're going to work on in 301. The put calendars and the call calendars and the flies are phenomenal hedges for your positions. They're much cheaper than buying the put. Now, it always comes back to expectations, right? I keep coming back to this. And each and every one of you has to be mentally disciplined enough to have to what?
Close it if it's if it's into your advantage to close it out, especially if something's working and the hedge is detrimental to that.
Yep, we're not there yet though, right? To have this discussion of what position we're going to put on, what do you have to do?
Well, you need a great plan.
Yeah, Craig, say it.
Scenario plan.
Yep. You have to put yourself through the mental strain of actually thinking through what can happen. Takes work.
Yeah.
It's exhausting. There's going to be days you're not going to want to do it. I will tell you, like in my own trading and the things we're doing, that is the biggest hole for me in what we do. Our scenario planning, but me specifically, my scenario planning right now is dog shit. It's really, really bad. It is a fraction of what I'm capable of being. And the reason that is the case is I'm too fucking busy doing all the other shit to have enough time to fully put out the scenario plans that I'm capable of putting out. And our trading absolutely suffers because my scenario planning is lazy. It's not lazy. It's the wrong word. Yeah. I'm not lazy. I'm not sitting, taking a nap, or blowing it off. But I have too much going on and it's getting pushed to the side and it gets reflected in our position management. It's really easy for you and for me to be long and be patting ourselves on the back. Our trades are working. Awesome. I'm doing great. I'm the trader I always said I was going to be, but I don't do my scenario planning because I'm just basking in the fact I'm making money. And then it punches me right in the fucking face. Punches me right in the fucking face. Right? So you guys can do this, but going to have to push yourselves. And what's awesome about it is when you push yourself, this separates you from everybody else. Right? One of the things just like in my own trading, I'm living in the realm of mediocre with my scenario planning. I don't like that. So we're trying to do things in my commitments to what I have in our education company to get me out of that. For you, this is the same kind of things you got to answer. Craig, for you with your fund, you already do a lot of this at an elite level. You know that, right, Craig?
Yeah, for my fundamental analysis. Yeah, definitely.
Yeah, you're elite at it. So the next step is taking this sort of thing and going one step further with all that hard ass work you did. And what's great, Craig, is you're bringing in people who actually can do that work for you. Then you can spend more time doing the next leg, which is this. And that's going to take all that work you did, and it's going to put you at a whole nother level. We were having discussion earlier today, right, about your competitors and other people that are starting funds in a similar kind of way. Well, this is a place, Craig, you kick their ass. This is where alpha is.